Well, Thursday's announcement by the Reserve Bank Governor to lower the repo rate by 25 basis points to 3.5% has been welcomed by many. For more on this, we're joined by property expert Tim Akinnusi, founder of MortgageMarket.co.za. A very good afternoon to you, Tim, and thank you so very much for joining us here on SA Today.
Thanks for having me, Flo.
Well, people can be, happy, and I suppose people who are interested in the property market might be excited by yesterday's sort of announcement. But what is the best advice really to consumers at this time, especially those in the property market?
Yeah, so it really has been a welcomed decrease in the interest rates by 25 basis points. But whilst that is not really a significant decrease, we've got to look at this at a cumulative level that since the start of the year, we've had literally 5 cuts, totaling over about 300 basis points. So that is exciting for any individual who's looking to get into property. And a lot of the focus has been on the fact that this lowers the cost of debt, which is great for consumers, especially in a difficult time like this.
Yeah.
But the other significant impact has been to savings, which unfortunately has not been positive, because a reduction in the interest rate means that it leaves very little incentive for people who have actually been saving up. And so for entities and consumers that are have relied on savings interest return, they now have to focus on investment, because they've got to invest and get a yield that's better than the current savings rate. But so this brings into sharp focus an asset class like property, because the best way to invest for the long term is when you actually buy property that can appreciate in value and, of course, give you a good yield over a long period of time. So as much as this is savings month, we think it should also be investment month, because quite clearly the Reserve Bank is committed to ensuring that we stimulate the economy by investing and by spending.
I'd like to ask a sort of practical question, given the fact that we're all dealing with the pandemic, and some people have been struggling with cash flow, for example. Considering that home loan payment holidays are coming to an end, what then would this mean for bond payers? I mean, you have this good news on one end, but you've also got to do some catching up on your side. So is it really a good news per se?
Yeah, so Flo, this is a very critical month for banks and for consumers alike, because this is the first time in 3 months that consumers will have to honor their repayments on either their car loans or their home loans, especially for those consumers that actually took the payment holiday about 3 months ago. Mm-hmm. So in many instances, what will happen is that there will be an extension of the term that the banks have given to those consumers to be able to keep their repayments the same as if the payment holiday actually never happened. So whilst this is great for a lot of consumers, that the fact that the banks have come to the party in this way, the reality is that the economic hardship hasn't ended, COVID hasn't ended, and so for those consumers who still need the payment relief, the advice to them is they have to be proactive to contact their banks or contact their credit providers and try and make further payment arrangements.
And just on that, sorry to interject, but just on that, you talk about those who might still, and it's the reality that many people might still actually be financially distressed even after that payment holiday that was given. What would your advice there be? A lot of people are considering, selling their property. Is it a buyer's market? Is it a seller's market? Where are we right now when it comes to property? And what advice would you then be giving to someone who's saying, look, I might just have to sell my property?
Right, so it is a very active market, and you obviously have to look at it by various, call it property value segments, right? So the middle market is the most buoyant. That's the market between 750 and about 1.5 million. So there's lots of activity there. But more importantly, if customers are feeling the strain, if COVID has meant that they've had to experience a reduction in their incomes, the best thing to do is to call the bank to ask for a restructure, to restructure their entire loan amount so that they can reduce this in line with the reduction that they have seen in terms of their income. But if they believe that this financial difficulty is going to be a lot longer than 6 months, let's say close to a year or potentially even longer, we expect customers to go to their banks and try to sell their homes without the distress factor. The bank will actually make some provisions to enable that to happen. And the reason why this is the best advice is that you get to preserve the value of the property. It will be sold as any other property on the market currently, and that from a consumer standpoint, you'll also be able to preserve your credit record. So whilst it's an active market, this is what you need to do if you find yourself in financial difficulty. But for those who are not in financial distress, it certainly is not the right time to put your property on the market, because you're unlikely to get a good price for it, because there's just so much supply there, and the demand is going to be at a level where buyers will be able to pick up good value homes for a steal. And you certainly don't want to be caught up in a position where your house is not fetching the most amount of value that it can fetch.
Thank you so much for that valuable advice and information. We thank you for your time, sir. That's Tim Akinnusi, who's the founder of MortgageMarket.co.za. Thank you, sir.